Now, after a record 55% surge in March, oil prices have carried that momentum well into the first week of April. Markets are once again reassessing the scale of supply risks tied to the ongoing conflict affecting the Persian Gulf. Brent crude, the global benchmark, has climbed to around $110 a barrel after briefly slipping below the key $100 mark earlier this week. The rebound follows fresh escalation signals from US President Donald Trump, who warned of intensified strikes on Iran's infrastructure if Tehran rejects ceasefire terms. And the rally may not stop here. JP Morgan now sees Brent rising to around $130 in the near term, with a risk of a spike beyond $150 if supply disruptions persist into mid-May. That's as US and Israeli strikes on Iran have prompted Tehran to effectively halt shipping through the Strait of Hormuz. Almost 20% of global crude is transported through the choke point. And with the conflict now in its fifth week, there are genuine fears of global inflation. According to the International Energy Agency, more than 40 major energy sites have been severely damaged, a factor likely to keep prices structurally elevated for some time, even if tensions do start to ease. Let's get more on this now with Jameel Ahmad in Dubai. He's Chief Analyst at GTC. Welcome back to the program, Jameel. Now, we've just seen the biggest one-day oil price jump in 6 years. What triggered such a dramatic move?
Essentially, traders that thought that Donald Trump's address on Wednesday evening, of course, that was April the 1st, if they hoped and thought and optimistic that there would be some cooling down of escalations, they had somewhat of a April Fool's joke, to use that pun, because essentially what we saw was, instead of a de-escalation or something suggesting that this unfortunate conflict could end in intensity anytime soon, it was quite the opposite. And it suggested that this issue with the Strait of Hormuz, the issue when it comes to not knowing when this unfortunate episode is going to come to a conclusion, there was more questions rather than answers following that address. So essentially, traders are now starting to price in that oil prices will stay higher for longer. And this market remains very much sentiment driven, for as long as the headlines continue to be very much sensitive towards suggesting that we're going to have more escalations rather than a de-escalation, the oil price is going to be inspired and have more motivation to continue to move higher.
Right, and JP Morgan is warning oil could hit up to $150 a barrel. Do you agree with that outlook, or is the market overestimating the risks, and how dangerous could that be for global markets?
The longer that this situation persists, the higher the probability is going to be that rather than it being a possibility, we're going to have more milestone highs in oil price. It's going to turn to increased probability. I do not think investors are now overestimating the risk, because you have a situation that has pretty much been prolonged now for 1 month. And there's no end in sight, because you're seeing, again, the indications, the communication is that if you want the oil that's basically just left there and it's stranded because of this very unfortunate situation, go ahead and take it. That's not the type of approach that the market wants to see for a de-escalation. So it suggests that investors are going to continue to move oil prices higher. Again, once we finally get good news that hopefully a de-escalation is coming, the oil price can drop very suddenly, and that's more than likely going to be the case. Nonetheless, for as long as that situation persists, there's going to be sensitivity towards moving higher oil prices. And I also think that global markets yet are not pricing in as much of a negativity that's going to have on the world economy. And now that we're heading into the second month, I do think that we're going to start to see more correlations across different asset classes and more sensitivity towards what the economic impact will be from this situation.
Now, we've seen markets swing sharply since the war began on mixed signals from Washington. Has the White House now lost credibility with investors?
This market remains very much sentiment driven. By sentiment driven, I mean that the headlines are very much spiking volatility. For more than 1 month, we're not watching economic data. We're not watching central bank moves and so forth. We're just watching what the headlines are going to be. So for as long as these headlines continue to shoot in either direction when it comes to the White House, there is going to be an issue towards investors remaining very sensitive. I can't say that the administration has lost credibility per se, because in some aspects, the assets that are benefiting from this very unfortunate situation is actually the US dollar and the greenback. So you're still seeing that investors are looking towards US assets as I would say, a haven of safety. But let's see what happens to the world after this finishes, because obviously there's going to be some issues when it comes to political tensions and geopolitical tensions, and whether the investors are going to lose some credibility towards US assets, I remain a bit doubtful because of how secure they've been for a long time. But again, there's going to be a lot of questions that need to be answered after this episode comes to a hopeful conclusion, and hopefully soon.
Right, we'll leave it there for now. Jameel, Ahmad in Dubai, thank you very much as always.